Brexit has naturally been a large topic in recent months. We've seen many UK fund houses launch or shore up operations in continental Europe prior to any decisions being made. Recently, Aberdeen Standard indicated that they are planning to set up an EU hub in Ireland in order to continue serving its EU-based customers post-Brexit. Jupiter Fund Management, which saw net inflows of €6.25 billion in 2017, has also indicated that they are looking to make a similar move. However, they are targeting Luxembourg as the future location of their new portfolio management entity.
Interestingly, Zoa, we are also seeing firms from continental Europe ensuring their operations in the UK will run smoothly after Brexit. Nordea AM is in the process of creating a UK-based subsidiary in order to protect local business from any fallout.
Somewhat in line with this, fund passport regimes are also becoming more entrenched in the Asia-Pacific region. In fact, Singapore, Thailand, and Malaysia recently signed an MOU which revised the ASEAN Collective Investment Scheme framework launched in 2014.
Yes, the new revision significantly updates the original framework, allowing easier access for small asset managers to offer cross-border funds. Originally, managers needed a minimum AUM of $500 million. However, this has been lowered to $350 million under the new rules. Furthermore, up to 100% of an approved fund's assets can be submanaged by a manager who is not regulated by a signatory of the pact. Let's quickly turn to Justin Ong, PwC's APAC Asset Management Leader. Justin, thank you very much for joining us. How do you see this new MOU? Will it bring the much-awaited success of the ASEAN passport? How does it compare to the ARFP? And which do you think will be more successful?
Thanks, Serge, for asking. Now that's a great question. How do we see the MOU? We see it extremely positively. I think this is one of the big changes that's coming through, and it's a great enhancement to the existing regime under the ASEAN CIS framework. First and foremost, I think the ability now for managers to sub-delegate management of the AUM to countries and asset managers outside of host country is a big change. It provides asset managers with a lot more flexibility in terms of how they want to manage a product and how they build it, using the best capabilities around the world. And I think that's a great start, not just for the managers themselves, but for the investors who get access to the best products and best capabilities. I think the second thing that's come across, of course, is the expedited approval process and the clarity now given that funds once approved or once lodged will have 21 days approval. Provides managers with a lot more clarity, a lot more certainty in terms of how soon they can go and market their product. So again, I think that's a great change. So how do we see that stacked against the Asia Region's Funds Passport? Well, at the end of the day, it's a very long-term game. The ASEAN CIS has been around for the last couple of years. It's not seen a lot of traction, but we do expect to see some interest picking up now that the rules have been enhanced. The Asia Region Funds Passport clearly is a much longer game, much bigger players involved in terms of countries. We have Australia, Korea, and Japan. So that's going to add a lot of weight to it. While the rules have been out, ultimately it's going to depend on the first two countries to sign on to a bilateral and start the funds on a cross-border basis, and then it basically goes live. So we think both have got a lot of legs. Ultimately, which will be more successful is going to depend on which managers feel more comfortable with from a distribution perspective. So rules, in terms of rules, fine, but how you distribute ultimately is going to win the game.
Thanks, Justin. I'm sure that as the passports grow in popularity, we'll see increased flows throughout the region. Now, let's have a look at what's been making headlines amongst actives.